What's up, guys? Filming another video. Today we're going to talk about refinancing. So what is refinancing? So refinancing, I have my notes here. It refers to you replacing or revising your terms of an existing credit agreement. So you may have heard of people refinancing their mortgage, auto loan, etc. So you're saying, okay, if I don't know what refinancing is, simply how can we put it? So let's say you want to have a more favorable interest rate or payment schedule or any type of term outlined in that loan contract. If approved for that, you'll be able to have the new contract take the placement, so it's going to replace the original contract. So why do people refinance? It's because when the interest rate changes, more often than not, when they drop, because I don't know anybody that wants a higher rate. When it drops, people say, okay, let me lock in a new rate. Let me try to refinance it. Now, it's not as easy as saying, okay, bank or company that I've done credit with or the loan through, give me the new rate. I'm a paying customer. You can't do that. You have to jump through your hoops again, just like you were the first time applying for that loan. So, whenever the terms of an existing loan are done, new interest rates come out. Maybe you think, I could pay it off better. Maybe I want a payment schedule that's sometimes higher in payment but less in time, so you can pay it off sooner, or any other type of terms when they become revised. So borrowers tend to do it when interest rates fall because, as you see in the housing market right now, people don't want to refinance because rates are going up or rates are staying the same. People are waiting till rates fall for them to be able to go ahead and refinance their mortgages. And it involves people such as the credit lenders reevaluating your business credit or repayment status. And consumer loans are often considered for refinancing, so the mortgage loans, car loans, and student loans as well. So yes, you guys have student loans, you can refinance those. And usually, my notes here saying that people generally want to seek refinancing for certain debt because they want favorable borrowing terms. Maybe you want to lower your fixed interest rate to reduce payments over the life of the loan, or you can change, like I said, the duration of the loan. So sometimes you're thinking, well, maybe just a little too high. Let me go ahead and refinance with the car company or my bank to have a lower auto loan. That's no problem because you're taking advantage of the rate that's given right now. But you also have a loan where you want to, you want to change duration. So, like I said, maybe you're thinking, well, say if you have a 6 year car loan, you're thinking, I don't want to do that because let's be honest, a 6 year car loan, that's very absurd. Yes, some people have to stretch out their payments just to afford it. In my opinion, if you can buy something in cash or you can find a better vehicle for a much cheaper price but still have it be reliable, it's better than having to stretch out a 6 year loan on a vehicle that you feel is not that much reliable or will not get you to the end of that loan period. And then if you have to give the car away or trade the car in and you still have your loan on top of that and you incur that loan and a new loan, you're basically just diving yourself deeper into the debt hole. So whenever you are able to modify your contract, you're able to have it to your advantage more often than not. So the most common motivation for refinancing is interest rates, or our interest rates, because they're cyclical, so they go along with the economy. And many consumers want to refinance where they drop because the economic cycle, market competition are key factors for interest rates decreasing or increasing. So it just depends what you're refinancing for. So when a falling rate environment happens, you're able to go ahead and take advantage of, like I said, that rate that's already went down. So if you were at 7% when you first started out, something is out there for 5.5%, and you're thinking, well, let me take advantage of that. But it's not as easy as you think. So, in order to refinance, your steps for that is that you have to approach your lender or a new one, but more often than not, you might as well go with your lender with the request and a new loan application. You cannot do the terms off of the same loan application. You have to do it off of a new one. So you're reevaluated for your business terms, your credit terms, and you may also seek to refinance on commercial properties for sake of your corporate balance sheet, and that way you could benefit from lower rates or improve credit profile. And there are different types of refinancing. So the first one, you have rate and term, which means that the original loan is paid and replaced with a new loan agreement that requires lower interest payments. So whenever you have the original loan and you say, maybe I could have an auto loan that's lower interest payments. You're able to replace that, and then once you replace that, you're able to have your new auto loan come out and say, well, I have went from 350 to 330 or 300. So it's in a simple term, rate and term is that okay, that original loan is done with, and now you have your loan that has a much lower setting for you. So whenever you have that type of loan, it's always beneficial to the person that is paying out the loan, or not paying out, paying off the loan, excuse me. And then you also have cash out refinancing, which is when the underlying asset, say it's your house, has increased in value. The loan, it collateralizes the loan that has increased in value. So it means that you can withdraw the value or equity in the asset, exchange for a higher loan amount and often a higher interest rate. So when an asset increases on paper, so say like today, inflation, your house has went up from 300,000 to 550,000. You can gain access to that value with the loan rather than selling it, and that increases the total loan amount, but it gives you more, the borrower, access to cash immediately while maintaining ownership of the asset. So the trade-off is you have a higher loan amount and often a higher interest rate, but you're able to have that cash immediately. So it's like you're having liquidity happen for you once you have the cash out refinancing. You're taking the equity out and you're saying, okay, I can have that cash now, but in turn, I'm going to have a higher rate, higher loan payment, but I get the cash, and maybe you want to put that down on another property. So it depends on how you do your finances. And then also you have cash in refinance, which is allowing you to pay down a portion, some of the portion of the loan for a lower loan to value ratio, or as known as smaller loan payments. So it's like you're putting more money towards the loan. It's when you put more money in and then you're saying, okay, I want less payments. So you're tweaking the contract and you're saying, okay, let me put more money in right now at the beginning so that way we can refinance this and I can have smaller loan payments. So it's just like putting a bigger down payment on the loan, except you're doing it when the contract's happening, not before it. And then you also have a consolidation loan, which is when you can obtain a single loan at a rate that is lower than the current average across several credit products. So we also have pros and cons to refinancing. So the pros is you can get a smaller, lower monthly payment and interest rate. You can have an adjustable interest rate, so you can have possible savings. You can get that equity out that asset that has went up on paper, or you can get a shorter loan term, allowing you to save money on interest paid. Now, here are the cons: is that if your loan term is reset to its original length, your total interest may outweigh more than that which you will save. If the rates drop, you won't get the benefit of a fixed rate mortgage unless you refinance again. And then you also might reduce your equity, because if you're taking out the equity in your home, then all that money that's been built up is pretty much going out in cash. Now, like I said, you can do whatever else you want with that, but do you want to have the equity in your home, or do you want to use it but potentially lose more than what you have in there if your other investment doesn't work out? And another con is that your monthly payment can increase with a shorter loan term, and you have to pay closing costs of refinancing a house. So whenever you refinance, you have to think about these terms and conditions that apply with it. Yes, it can be better, but also it can hurt you. So it all depends. Would you rather refinance with a new contract, a new loan amount, or would you rather keep what you have? Because refinancing is not everything. It is a way to help people, but it's also a way for you to dig yourself deeper into debt if you do not know what you're doing. So let's just have a example, and I'm gonna close it out. Let's say that two people, married couple, have a 30-year fixed rate mortgage. They've been paying it since they first locked up their rate 10 years ago, which is 8%. Kind of sounds like today. And because of economic conditions, the rates drop. Let's hopefully that's next year for us. But in terms of the example, they reach out to the bank and they have a new rate at 4%. So they have half the rate. They lock in a new rate for 20 years while lowering the regular monthly mortgage payment. If those rates drop again in the future, they could refinance more. However, they have to be reevaluated for their credit and their loan and see if they're still in good status, good standing. So whenever you refinance, it can help you, but at the same time, you just have to know how credit worthy you are. You have to understand that what you're doing is taking that loan contract and you're replacing it with another one. So, will it be beneficial to you in the long run? Can you budget it? Can you put it within your necessities? Those are all the questions to ask. So, guys, thank you for tuning in. Tune in for the next video.